Stocks are extending losses this morning, hit by diminishing wagers on Fed interest rate cuts and a further oil price spike that poses a fresh threat to inflation. Our next guest says a negative January could be a headwind for the rest of the year. Tyler Ellegard is portfolio manager at Gradient Investment, and he joins us now. Hi, Tyler. Thanks for being with us.
Thanks for having me.
All right. So this January effect, is it a wives' tale, or could it meaningfully impact the stocks this year based on what history tells us?
Yeah, I think it's largely a wives' tale. I think when the market goes up 75% of the time, and January is historically a positive month, you get that effect. So, but you oftentimes hear about so goes January, so goes the rest of the year, right? So, yeah, we think it's more of just a wives' tale than actual reality.
All right, so investors continue to bet and price in the fact that the Federal Reserve may be on hold for quite a while until I believe they're pricing it in or betting on an October cut. What do you think of what's transpired the last while?
Yeah, I mean, we obviously got a strong jobs report here in the U.S., added many more jobs than what was expected. Unemployment came down to 4.1%. So I think on all fronts, you're hearing that the Fed has done their job in landing this plane softly, right? So what does that mean for interest rates? Well, it means that the Fed doesn't necessarily have to cut rates as much as investors were hoping in 2025. Back in October and September, we were expecting 6 to 7, or the market was pricing in 6 to 7. Then we were pricing in 2 to 3. And now after that jobs report, we're only pricing in 1 for 2025. So what does that mean for interest rates in general? It means rates have to go higher from here if you want a traditional yield curve. So that's really spooking the market because higher interest rates tends to impact businesses and how much they have to pay in interest on their loans.
Right. We see the U.S. 10-year yield at a 14-month high, to your point. So how does the incoming Trump administration play into this? Are investors expecting generally the Trump administration to be inflationary based on their various priorities and policies?
Yeah, there's a lot of unknowns right now. So when you think of the tariffs, when you think of oil, when you think of taxes, there's a lot of moving parts to this, right? So you've got some inflationary impacts on tariffs. You've got some, hopefully, when Trump talks about drill, baby, drill, oil prices come down, which would help the consumer, and then maybe some tax cuts or the extension of the current tax code here in the U.S. on individuals, maybe some changes for corporations. So yeah, there could be some inflationary pressures, but I think a lot of it is perception versus reality right now, and we really just have to wait and see for what he does on day one or his 90-day or 100-day plan in office. I think we just have to really wait and see to make that official call on what is going to happen to inflation.
Tyler, I understand you expect artificial intelligence to continue to be a major theme this year, but how do you think it's going to evolve in 2025? And will it broaden out, and will we see some more different, interesting names to think about?
Absolutely. Yeah. I mean, for the last 2 years, AI, the Mag 7 has been at the forefront of investors' minds, and I think it will continue to be. But our theme for this year is that it's going to broaden out, or the market will broaden out, and not just a broadening of the entire market, but a broadening of AI specifically. So we saw little pockets of it here and there last year, whether that was utilities, data storage centers. I think it's going to be a little bit more pinpointed rather than the sector as a whole of different areas. I think it's going to be specific stocks that have real exposure to AI and potential impacts of the CapEx spend that's happening from the Big Seven.
All right, you've got some names for us here. Palo Alto Networks. Run through a few of the reasons why you like it.
Absolutely, yeah. So when we're talking about this broadening out of AI, I think software specifically is going to be the key player here, and Palo Alto sits right in the prime spot for that. The stock itself has pulled back about 20% from its recent highs, but when we think of the ongoing need for cybersecurity, the ongoing need for enhancements and efficiencies from AI, Palo Alto has been working on AI and efficiencies for the last year and a half. And then when you think of cybersecurity, that's what they do. They're a platform for cybersecurity, and companies are just going to need more and more of it as these. When we think about AI, it can be good, but then there's also bad parts of AI, right? So when you think of AI in general, we're going to need more and more of that cybersecurity, and that's where Palo Alto sits.
Another company you're favoring, Tyler, is Eaton Corp. How come?
Yeah, I think it's a little bit different take on AI and going more onto the industrial side. But these are electrical component companies. When we think of their transformer business specifically, right, the lead times for the stock used to be, or for transformers used to be 3 to 4 months. Now they're looking at over a year for the lead time. So the demand for their products is significant, and the company is investing about $1.5 billion into that business to build capacity. And so, yes, this year might be a drag on CapEx and cash flows. But I think if we start to look out to the end of this year and even into next year, Eaton's going to be in a prime spot to take advantage of this type of demand and just keep this price momentum of the stock going.
And then ASML out of the Netherlands, our previous guest, our featured guest this morning, Tyler, said he had a good run with it and he's gotten out of it. You're recommending it, so that's what makes a market. Why are you recommending it?
Right. So I think after the last quarter, there's a lot of consumer sentiment or poor consumer sentiment around the stock because numbers were quite light. There are new technologies that are being developed. Canon has come out with a new technology that may rival ASML. But when we think of ASML's business as a whole, the relationships, the research and development that they've done, yes, maybe they're not first to market on this brand new technology that Canon has brought forward. But when you think of the overall relationships that this company has built and the significant amount of research that they have done, they're going to come to market at some point and bring a similar type of technology. And I think it's going to be a tailwind for the company in general. But I just think that the consumer sentiment, the valuation around the stock is so in the dumps at this point, if you want to call it, that it has to be a name that we have to hold in our portfolio. Because I think if we look out in 6 to 12 months, the company's going to turn around. Management will turn it around. And they'll come out with these new technologies that may be rivaling the company itself.